Radixas, welcome to our Financial Facts channel. We Radixas will give you some valuable tips and tricks on how you can make yourself financially independent regardless of what you earn now and where you live now. Today we are going to talk about what you should know about a stock market correction. If you understand the market correction well, you have a really good chance to make money in the stock market. First, let us see what is a market correction. It refers to a price decline of at least 10% of any stock or bond or market index and followed by a temporary upswing in market prices. How does it work? The stock market's value is always rising and falling. Sometimes the market will experience short-term gains even though nothing has really changed. These increases of market value are due to investor psychology on the part of investors' assumption based on the previous gains. As more investors buy into the trend, the price increases. Once the price is high enough, buying will slow down and some investors start selling for the current profit. This decrease in price following a short-term increase is called a market correction. For example, let's assume there is a stock ABC that is currently valued at $80. Expecting gains, the investor continues to purchase ABC and the price of the stock goes up to $100 over the next month. At the end of this month, some investors stop buying the stock at a higher price while others start selling the stock to lock in their gains. So, the market readjusts and the stock price of ABC falls to $90 per share. So, the ABC stock experiences a correction of roughly 10%. Now, why it is important to know? A correction in the stock price followed by an upswing in an indication of the stock's true market value. This may not indicate a loss in the company's value. Market corrections are a big part of technical analysis. Many investors will use indicators to try to determine when the correction will begin and end so that they can buy when prices are lower. As an investor, what you need to do with it? Number 1, understand they are more common than you realize. No need to be panic. S&P 500 has undergone 36 correction of 10% or more since 1950. That's pretty much one every 2 years. Number 2, correction is often short-lived relative to bull market rallies. The stock market tends to trend higher more often than it's declining. Number 3, it is a great time to review your holdings. Since it is a temporary drop, there is no reason to panic and sell the stock. Number 4, you will probably regret not buying stock during a correction. Don't be afraid of buying more stock during a correction. Since 1950, bull market rallies in the S&P 500 has completely erased all the 35 stock market corrections, often within a matter of weeks or months. Thank you.